Welcome, everybody. My name is Lee Harris. I'm one of the co-founders of Trading Research Group. Jeff Mayhem, say hi, Jeff.
Hello, morning.
There we go. He is our other co-founder, and also with us today from Trading Research Group is Jonathan Van Kloot, who is our community manager, aka cat herder in chief.
Meow.
Oh dear. I see we've got that's terrible. We've got a couple of our members on here as well, one of our moderators, Philippe. But for everybody else, I guess you've come along because you've seen our invitation on Facebook or by email, whether it's email from Emoji Trading, which is my order flow tool venture, or directly from Trading Research Group. And you're interested in understanding a bit more about Trading Research Group, understanding a bit more about our education, or you would just like the opportunity to ask us anything, which is what we're here for today. So what we'll really do to kick things off is go through a bit of background on our upcoming beginners course, which starts on the 9th of July. A bit of how it came about, what we do with it, and how it sets you up on a path to some really good understanding of applying order flow to your trading. Now, Jeff and I both come from a background of full-time trading. I dabbled in the market since, God, 1991, I think, was the first time. Started out fiddling about with options and then CFDs on equities in the UK. But I turned full-time in 2013, 2014. I exited from one of my businesses and had the opportunity to really throw myself at futures full-time. I spent some time in a prop firm in London to get some education, which wasn't fantastic, frankly. But what it showed me was I didn't need this trading arcade / prop firm environment to really focus on trading full time. What it did teach me, though, was that everything I'd learned about technical analysis, and so I was really deep into TA, had all the books, Bollinger on Bollinger Bands, John Murphy, Technical Analysis of the Futures Market, lots of wiggly lines. None of this was relevant. What I was doing in a prop firm was basically trading levels. I was looking at domes and trading levels. But unfortunately, the prop firm I was in, no one could explain how to trade using the dome. The attitude was stare at it long enough and you'll get it. Fantastic. So I threw myself really deeply into order flow and understanding the footprint. And what I ended up doing was creating various tools to make my understanding of and interpretation of the footprint easier, which I then commercialized through Emoji Trading. And what I've done since that point in time, other than trading full time, is really help people learn how to read the footprint from the raw data, understand this stuff from first principles, because with that first principle understanding, you can then pick and choose from tools like Emoji or Gomi or MZPack or whatever else to make your life easier. But if you come to this business thinking, I'm going to buy XYZ tool and it's going to help me, if you don't actually understand what that tool is doing, then you're in an indicator mindset and you're going to be blindly following red and green quotes, signals, and it just doesn't work, which may be the experience that you've had. Now, Jeff and I met in inverted commas, probably mid to late 2019, when Jeff, through his Facebook group, Surfing the Markets, organized a workshop for tape reading and order flow and trading using the Dome, which ran for about 3 to 4 months. And I'd been following Jeff's posts for a while, and I was interested to see how does somebody who clearly can trade, how are they going to explain their methods and mechanisms? And Jeff came the closest that I have encountered of anybody into explaining how to trade order flow using the Dome. And one of the offline questions we received, which I've got up on my screen at the moment, is, is using the Dome necessary for any of the other setups listed in our curriculum? And one of my frustrations, ongoing frustrations, is that you have a whole bunch of people that trade and they wear this badge of honor saying, oh, I'm a Dome trader. I don't use charts. I trade the Dome. And you ask them what they're doing, they can't really explain what they do. And when you dig a bit deeper, they're not really a dome trader, whatever that may be. Because if we get really literal, what does dome stand for? It stands for depth of market. In other words, the order book, the resting orders, the liquidity. But everybody who wears this badge, their 5-star McDonald's capability badge, which makes them a dome trader, has got a volume profile and current and recent volume on their dome. But that's not depth of market. That's stuff that's occurred. It's not liquidity. It's not what might occur. It's not what's available to occur. It's trades that have occurred. Yeah. So they're actually making the bulk of their decisions based upon historic traded volume, which is what we see in a footprint chart. But then if you say to them, but you're looking effectively at a footprint, they go, no, I'm a dome trader. I don't use charts. And domes that you find, on Jigsaw, who call it accurately depth and sales, is the Jigsaw Dome. Most professional grade trading tools like Jigsaw, like TT, Sierra Charts Dome as well, let you see this blend of liquidity and also historic stuff that's traded. And the key to our approach on trading using order flow is being able to read really well what the volume that has traded at different prices means and what it tells us. So we get really deep into understanding the impact of volume that's traded at different prices. Now, ultimately, all of this is recorded as time and sales. It's the tape. It's, if we go back to the 1920s, what's Rollo tape, Wyckoff, yeah? It's all these guys who are standing over the ticker tape. It's what they were reading and forming a mental picture of in their minds. Charting came later, either because they drew it literally, or computers came about and they could graphically represent price over time. But all of this stuff around order flow is tape reading. Yeah, we're forming a picture of the trades that have occurred, and we are looking to understand how, when we're trading at levels where trades have previously occurred, what is going on now, considering what has gone on in the past. Now, whether we look at this as a time and sales list for tape, whether we organize the tape into a visual representation like a footprint chart, which is an organization of the time and sales over a time period by price and by which side the trades occurred, whether it's a buy or a sell, whether we put some volume information like wave volume on a fast chart and look at wave volume, Wyckoff's methods. Yeah, it's all doing the same thing. We're interpreting the impact of volume at price over time. So we get really deep into ways of understanding this that work, whether you are brought up on charts and you want to read things left to right because that's comfortable, lots of candlesticks, or whether you like the footprint chart, whether you just want to see an aggregation of this and a profile in the dome. Now, that is the fundamental approach to trading with order flow. But just because you can read the data doesn't mean you can trade. The key to successful and professional trading is having a process, and that's not a setup, it's having a process to your trading. How do you manage yourself? How do you consider context? When do you trade? When do you not trade? When do you trade in certain ways? So you've got to be able to define a process around your trading, and you also need to trade certain setups. You have a playbook of setups. Some of these setups might be scalping. Jeff is an expert scalper. He'll take dozens, maybe hundreds of trades per day. And our attitude is every trade starts as a scalp. But it doesn't mean you go blindly into the market just because, I can get in and boom, I get a few ticks. Conditions have to be right. So you need to read the price action, which is something else we get into. Yeah. Are we in a state of ebb and flow? Not moving sideways, but are we going backwards and forwards in a range of price levels? Are we moving with high momentum in one direction? Or are things just going mad crazy all over the place, which is price discovery, which we'll typically see immediately around a news event, such as we saw this week, the moment the FOMC statement came out. So we look at price action to determine things. We can also define trade setups based upon structural levels in the market, such as the boundaries of the day session, the overnight session, maybe midpoint, maybe the first hour's range, the initial balance. And we also can look at statistics behind the way the market behaves over time, constrained by the structure of the market. And this is something I get into pretty deeply. For example, the first hour's range, which is a very popular metric known as the initial balance in market profile terminology, ES will break the first hour's range pretty much every trading day. 98% of days break the first hour's range after the first hour has formed. About 35% of days break both sides of the range. 2% of days don't break either side. So knowing the behaviors of the markets that we trade structurally, we can start to build some really interesting setups based upon big picture. Here's the behavior that we understand in the market. We can also look at opportunities that sit within price action. So if it's ebbing and flowing, how can we take advantage of this? If it's moving strongly in a particular direction, how can we take advantage of this? We can look deeper inside the traded volume, the order flow, using things like the footprint chart in the context of the market structure and the statistical behavior, to then start to build statistically advantageous and gameable setups that give us an edge. But if you have no edge, if you just turn on your computer, pull up your 5-minute chart, and you believe your edge is, oh, MACD has crossed over and there's confluence with the RSI, you don't have an edge. Yeah, you're relying on lagging price-based wavy lines, which ain't an edge. An edge comes from statistical behavior where probability is overwhelmingly in your favor if your process allows you to A, identify it, B, execute it in the right way. And that fundamentally is what Trading Research Group is all about. And we founded Trading Research Group after Jeff's 2019 course had concluded in early 2020. And at that point, we had about 50 people who had been on the course who said, you know what, we've got a really good group here. It would be a shame for this to dissipate off into the ether. So we put together Trading Research Group. It's kind of commercially hosted by Emoji Trading, so we've got the infrastructure to do that. But it is platform agnostic. It doesn't preach any third-party indicators or visualization tools or whatever else. Our whole ethos is about development of trading processes and setups and understanding order flow from first principles and the raw data. And we started out with this core group of graduates, about 40 people at that time, who are who are known colloquially as the Motley Crew, our 2019 graduates. We had new members come on, but what we found was after we'd done various educational workshops and clinics, all of which are recorded, all of which are available in our library, which is something we'll go through, we found that, you know what, there's an onboarding process to getting this knowledge. So during 2020, Jeff and I spent some time thinking, what is the bare minimum amount of knowledge that you need to get to go from zero to being able to scalp and also trade some of these simple market structure trade setups safely? And we put a course together called Zen and the Art of Order Flow Trading, which was a 12-session class where we taught all of this stuff, and it was 3 sessions a week over a 4-week period. We've taken probably a couple of hundred people through this class. Overwhelmingly, people have had a really good experience, give us very strongly positive feedback. And the majority of people who've taken that bootcamp end up as members of Trading Research Group. What we found, though, this year was people were asking for something that played out more quickly. 4 weeks they felt was too long. So we condensed it even further, and we came up with a new order flow for beginners format, practical trade setups, where we have taken the essence of what we teach in our 12-class Zen bootcamp, crunched it down really intensively into 3 live market sessions. Correct me if I'm wrong. Well, yeah, effectively 3 live market sessions and a pretty intense weekend where Jeff does a 2.5 hour session on price action scalping. I do a similar session on market structure, statistics, and applying the footprint to it. And this is a very quick and effective way of exposing yourself to the TRG way of trading, the way of thinking. We include a couple of weeks TRG membership at the end of this 1 week class, which then allows you to start to explore more of this knowledge through our library of recordings, other clinics, interaction with the group. Now, I would absolutely not suggest that you can learn order flow in, well, you you can learn what we teach you in 1 week's elapsed time intensive. It doesn't mean you're going to be a great practitioner. Yeah, I can teach you how a piano works, how the keys are laid out, how you apply your fingers to it in the same period of time. You're not going to turn into, I was going to say Elton John. Don't know why I picked Elton John. Pick your favorite pin. It's Billy Joel. There you go. John Legend, whoever. Yeah, 1 week's intensive acquisition of knowledge isn't going to suddenly make you an expert trader. For some reason, the business of trading attracts a lot of people who think that magically this skill can be acquired really quickly and they're going to become gazillionaires. Yet they wouldn't expect to learn the piano that quickly or be an Olympic grade weightlifter. Maybe they would, who knows. But what this course will give you is your eyes will be opened to the stuff that is relevant and important in order flow trading. You will know what to concentrate on and what to practice. And then within Trading Research Group, which we induct you into for a complimentary 2-week period, you've got access to a whole community of like-minded people, a whole bunch of live sessions. We run 4 to 5 live sessions every week, and our library with thousands of hours of videos now of live trading sessions, more educational clinics and workshops, and you are at a really safe and well-defined starting point to really become capable and adept at trading using order flow. So we'll go through this in a bit more details as we go through the session, but I think I've spoken for enough right now, kicking this off. Jeff, why don't you introduce yourself and add a bit of flavor to some of the stuff that I've just spoken about?
Wow. Excuse me. Thank you, Lee. I'm Jeff May. I'm co-founder along with Lee. My trading story, the market has been a passion of mine since I was a kid. Started trading when I was 13 with some money I got for my birthday. And I've been pretty much trading full-time ever since. I had a career in tech as well and in venture capital, but trading has always been my passion. And I've between different startups and whatnot, I've traded full time, and there's only been a couple times in my life. I'm 61 and I've traded 48 years, and there's only been a couple of times in my life that for health reasons I walked away from the market, for health reasons unrelated to the market, I should say. I also used to race motorcycles and cars, so my body's kind of busted up. Anyway, I've only really walked away for maybe 6 months at a time twice, and otherwise been pretty much continually here. So for me, the markets, I did the same thing that most people did. I learned, technical analysis, and, that was very different in the 70s than it was in the 80s and 90s. And mostly I've been a speculator. I started by buying options and takeover candidates. That's kind of my way of the greed is good 80s. And in the 90s, I started late 80s and early 90s, I day traded OEX options and traded the crack spread in crude oil, which is basically the difference between crude oil and refined gasoline. And if you ever watch those markets, they move a lot, so they're the perfect place to speculate. Anyway, long story short, order flow was something I started paying attention to in the early 2000s in the form of wave volume. Because in the 70s and 80s, we couldn't get real-time volume. After the fact, you could kind of get it. And then in the 90s, we could kind of start getting real-time volume, but you couldn't break it up by bid-ask volume. So, you could see it was traded. You could see if it upticked or downticked. And from those things, you could infer something about the trading, but you didn't really know what was going on. And what changed dramatically was, bid-ask data coming in the 2000s, and, TT, what they used to do, and they still do. That was kind of the first one with XTrader. And a lot of folks now have different types of order flow platforms. As Lee said, we're very platform agnostic. I run Sierra Chart and NinjaTrader and Jigsaw all together. And in a minute, we'll take a look at screens and we'll look at some of the stuff that Lee and I do. But anyway, what the kind of epiphany for me with this stuff was when I started realizing that all of the stuff I used to do with technical analysis, and I've done it all. I've tested everything. You name it, I've tested it, and over all the years. And it was always modeling something in the past, and there was always an inference that had to be made. Like, if a trend crossed, you had to assume that behavior was going to continue. There was no way to know whether a one-time event caused that trend to cross, your MACD or whatever, pick your technical analysis poison, or the pivot level, or any of those things. And what changed was all of a sudden we could see, boy, at the low of the day, there's a lot of action down there. We can all see the volume, but this is all going by on the bid. It's getting slammed. They're selling it down, or whatever, vice versa as well. The point is, we now could see what was actually happening. And for me, this was like the holy grail of my 48 years of trading. Now, all the stuff that contributed to my scalping edge, I could now look at in a matter of a second at a time if I wanted to. And that was just really powerful. So from that point forward, I've been really heavily into scalping order flow for being in the market the absolute shortest amount of time possible. If you're in the market, you're at risk. So if you can go in, take money, and get right back out, that's kind of my approach. Every trade is a scalp unless it proves otherwise. But there's a lot of circumstances where I will put a trade like that on, and my expectation might be, I'm going to grab a couple of ticks or 10 ticks or whatever it is. But I'm going to leave another one on because this is a point that we could have a significant reversal or what have you. So that's my approach to trading, is to find really, really high odds places, in other words, where I have an edge that something is going to happen. And Lee and I both like to look for edges that are well north of 70, 80%. And the two things that we look at from the structural view and the price action view give a lot of examples of that. And so what it boils down to, and this is the holy grail, as I said a minute ago, what it boils down to is if your trading is working on any given day, it's because you're following your process. And if you ignore the results and make sure that you're doing your edge, you're trading your edge, then the results take care of themselves over time. And that's a really liberating thing to have as a trader, where on any given day, I couldn't care less what the P&L is. I mean, of course, I look at it, but I let the market kind of give me opportunities where I know, okay, right here, this is a 90% chance this is going to happen. So I'm going to put on some trade here. And if I'm wrong, I'm wrong. And if I'm right, it pays off at whatever, it could be a couple of ticks, or the market could turn around and give me 50 points. So that's my approach in a kind of a long nutshell. But one of the things that's really been a growth for me, which is significant when you're 60 years old, is I've integrated a lot of the structural approach that Lee takes into my scalping. And again, that's the sweet spot. Scalping gives you, when you're looking to go in and be right away, or realize you're wrong and get out of the way. That's what scalping's about. And if you can do that decision process, okay, right here, I'm either right or not, and it's going to tell me right away. But if you can do that at a place where the market might be forming a low for the session, like the low of the initial balance getting taken out by a couple of ticks and then reversing. And those are places where it's not just going to give you a couple of ticks. So that combination of the two approaches is really what's powerful, in my opinion, here in TRG. So let's see, Lee, you still have do you want to show, what do you want to do next here? Do you want to show some stuff from your point of view? And
yeah, let's do that. Just one thing you mentioned, edges of 80, 90%. Let's just be really clear for everyone who's watching. We're not talking about risk reward ratios. We're talking about probabilities of things occurring. So we do not trade with an approach of risk reward ratio must be 3 to 1. We don't trade with fixed targets or fixed stops. Take profit 5, stop loss 20, or take profit 20, stop loss 5. The reason being, this stuff doesn't work. Yeah, what works is understanding where volume is positioned, how this relates statistically, and how you can take advantage of it. So
that's an important clarification. Thank you.
So there was somebody in our Volume and Order Flow Traders Facebook group, who actually disappointingly isn't attending today. They're big into equities and ETFs at the moment, and trying to apply order flow to that. And they asked whether their rule set, which they sent me privately, would work on futures. And their rule set was all, don't risk more than X percent of equity on any given trade. Target 1 is at this, target 2 is at this. If this percentage ratio is, this versus this, I thought, you have so much to learn and you are wasting so much time on your current trading approach versus what you could do with order flow on futures. Want to stress, when you hear us talking about probability and 80%, 90%, we are absolutely not talking about risk reward ratios. It's not even we throw his stuff away. We don't mention stuff. And key thing in our teaching style is, a lot of time people will say, oh, but could I use XYZ on this? And our response is, do you see it on a screen? Are we talking about it? If we are not talking about something, there's a reason for it. It's either not important or it doesn't work. And trading, as people navigate their way through trading, they accumulate a lot of knowledge, whether or not it's valuable knowledge is another thing, a lot of tools and indicators, and they put layer upon layer upon layer of stuff together, thinking the more things I put on, the better it's going to be. If I enhance my MACD crossover system with order flow, it must be better. I thought, well, if your MACD system isn't working, why don't you throw it away and look for something that is? In the same way that people find it very hard to exit losing trades, they find it very hard to exit bad knowledge or bad tools. And adding more to something mediocre does not make it better. What you have to do is have the smallest possible set of really reliable and robust tools and techniques and use that. And both Jeff and I strive to have as little as possible on our screens, because less truly is more. Our brains can only process so many decision points. And the people that look, I'll look at 9 different time frames for Confluence. You are overburdening your brain in trying to make a decision. You will get weaker and weaker decisions by adding more and more decision points. JVC Jonathan has said this exactly right. It is a sunk cost. People are bad at exiting losing trades. And
hey,
Lee,
let me just jump in here real quick. There's a conversation going on in the text, and some people are going to look at the recording and they're going to have missed this whole conversation. So just while it's relevant, before we move on too far into what you're about to do, I got a quick question here, which was a short question, if you don't mind. Talked about the time and sales a lot. What about the limit orders in the book? Do you look at them too? I responded, yes, but they're not an important part of what we do. It's not part of the edge. It's part of the potential where liquidity is. But liquidity are either intentions where people actually want to trade or they're spoofs, but it hasn't happened yet. We want to see where people have actually made a commitment by putting a trade on. And so when we talk about the dome, I trade on the Jigsaw Dome, which is, yes, the order book is there, but I actually have it mostly grayed out. If you've ever looked at any of my posts of it, what I'm looking at is where the volume is executing, where it's trading, both instantaneously and over the last period of time, whatever period of time I'm looking at. So, and Jan responded, I thought dome traders pay more attention to the dome. Okay, so back to the terms. Dome, D-O-M, is depth of market. A strict dome like Lee has right up here on the right side of his screen is showing that with just the orders. That's a dome. I don't trade off of that. I trade off of depth and sales, which shows trades as they're filling. And it's a different thing. In fact, Lee, do you have a picture somewhere real quick you could put up, or should I grab it? Let me see if I can find one.
I'm going to pull one of my domes down. So what I have here, I've just got this is NQ. Oops, that's the bottom.
Okay. Anyway, while you're doing that, let me continue with the question. So for example, what I'm watching in Jigsaw and what Lee's about to show is that it not only maps out the order book, but it maps out the orders as they're filling, whether it's on the bid side or the ask side, and it plots that. So it's forming a baby footprint is what it's doing. And in the Jigsaw case, there's two of them, recent and current trades, and they're called total and recent, I think, in Sierra or something like that. They're the same idea with a different name. Yeah. So that's a difference between the dome and depth and sales. None of us use just the dome. Those of us that are trading off those are trading off depth of market and sales. So,
which was what I spoke to earlier. I mean, yeah, and if anyone you encounter who claims to be a dome trader, whatever that may be, ask them what they're looking at, and I will wager that they'll say, oh yeah, well, I've got the volume profile here, or my current and recent, or current and total. They're looking at history. We'll pay a little bit of attention to liquidity. So here are the resting orders, yeah, in my dome. But they are really not making big decisions around the changes going on here. I know you use Bookmap, so in Jigsaw, in Bookmap, in Sierra, in ATAS, in Motivewave now. You can do these market depth historical charts, so you can see history of depth.
Real quickly, let's come back to this, but the one that's the most visual, I have one up right now, so let me share it real quick.
Yeah, go for it.
So this is just a picture from one of my Facebook groups, and this is a Jigsaw Dome. And when I say I'm trading off the dome, this is what I'm seeing. So let me turn on the spotlight thing here. And I'll finish answering this question, and then we'll go back to where Lee was going next in the presentation. But so anyway, this is the volume profile over here on the right. And then I've got the order book right next to the price on either side. And I've got it grayed out. It's very lightly shaded because I'm really not that concerned. I can see where there's big volume, but what I'm much more concerned with is the next two columns over. These are trades that have actually filled on the bid or the ask. And again, I can reset these at different times and start a new set of columns. But when we talk about the dome is just this and this, the order book. And these other two things are really much more important than where resting orders are. I also track a visual of what's being stacked and pulled off of the order book. That's what this is right here. It's called a flip chart. And it's just summing up the orders being removed and added to the order book over levels near the inside. But again, it's important to understand when we use the term dome in our world in TRG, we're talking about depth and sales and recent sales. And none of us focus very strongly on the depth. Now, there are some exceptions to that with market by order and whatnot. And with that, I'll pitch it back to you, Lee, because just the rest of this question, there's other comments. Pavel, hey, Pavel, good to see you, Trader PD. He said there's times when limit order stacking or pulling with some sort of an edge. I see it as an edge, and that's why I've got that little graphic there. I see it as an edge when, for example, let's say I'm short. It's a filter for me. If I'm short and I'm looking over here and the book's getting stacked, in other words, orders are getting added to the book on the buy side, that's going to be of concern to me. But if I'm short and I'm seeing pulling and we're going down, then those are all the things that I want to see if I'm short, trades going by on the bid, blocks going by on the bid. So it's the synthesis of these things, not any one thing. And none of these are an edge. It's really important to understand this. None of these are an edge. These are the results of what's traded. An edge would be, for example, let's say it gets down to this ledge of the session, the bottom of the volume profile. Lee and I will tell you that if we're going that direction and we get down that way, there's a 99% chance that low price will get taken out. And we trade this every single day. A bunch of our people in TRG do this. This is a ledge breakout and it applies at the top too. But that doesn't mean if we're sitting in the middle of the range here that you should get short because there's a 99% chance we're going to break that. You have to take it in a gestalt together. You have to say, okay, we have to be going that way. There has to be some measurable momentum, and that's what this stuff over here is for me. And then we have to be close enough that it's a target, and close enough in ES might be within 8-10 ticks, and in NQ within about 25 ticks. And at that point, our edge, This is what an edge is. Our edge appears. We know that under those conditions, there's a 99% chance that low is going to get taken out or that high. It might only be by a tick, but we know it's going to happen. And that's, we can statistically prove that with past. And in the future, it works over and over again. So anyway, that's one simple example of the difference between an edge and just things that are happening in the market. Okay, so let's see. Okay, cool. So let me give it back to you, Lee, and let you proceed on the agenda. I just really wanted to answer that question and clarify what we were talking about. I do share those a lot. So, okay,
yeah,
and please show it on yours too. Thank you.
Yeah, and also this discussion of, you know, dome versus depth and sales versus footprint, because one of the offline questions we got, you know, does this approach, this particular gentleman's, he's a Wyckoff spring up thrust trader, it's something Jeff gets into quite heavily. Does this approach require the dome? Is using the dome necessary for any of the other setups listed in the curriculum? I prefer to trade from a numbers bar / footprint chart for order flow, and I'm not interested in using the dome. Why not interested in using the dome? Are numbers bar charts the favored approach with any of the setups in curriculum? What people don't seem to grasp is that traded volume is traded volume. Yeah. Whether we choose to look at traded volume in a footprint chart. So here is my 30-minute footprint chart, which is how I primarily assess what's going on in ES, and then use that as the guide for the rest of the equities as a group. So I'm looking at traded volume here, and I'm slicing it up horizontally into 30-minute chunks, because this allows me to consider market profile, and I'm looking inside each 30-minute market profile TPO rotation. But I can also have, what I've got here is a volume profile on the left-hand side of the session, yeah, but I've put the broken out bid and ask numbers here, and you go, oh, it's a footprint. Well, you know, it's traded volume. Do I call it a footprint? Do I call it a volume profile? Don't really care. I've also got the difference at each price level, the horizontal delta, so 255 minus 139 equals 116. I'm painting this as a delta profile and as the numbers here, yeah? I use this for my analysis as well. Now, within my dome columns, yeah, if I set my dome up like Jeff's, and aside from listing the liquidity, I could have columns that were showing the total volume transacted on each side since the session started or until I reset that, or what's traded recently, and you know, within, I don't know, 2 seconds of that price, it stays there, otherwise it disappears. All of this is traded volume. So it's like a mini footprint, but whether we call it sales, which would be Jigsaw's nomenclature, or we call it a footprint, or we call it a volume profile with that detail, it's all the same stuff. We are looking at the aggregation of volume that has occurred over some time period and doing some pattern recognition on that in order to make some trading decisions. So for this particular question, you know, is using the dome necessary? It all depends what this person means and interprets by the dome. And actually, yeah, this goes back to something I said earlier on, which is very few people that claim to be dome traders or educate on the dome actually explain what it is they're looking at or on what basis they're making decisions. But the key to our approach is primarily looking at patterns in traded volume and interpreting what is happening right now within this context. So I wanted to talk to the 3 mentions of the 3 allergic reactions to the word dome here in these offline questions. And we'll come back to the Wyckoff question a little bit later when Jeff talks about Wyckoff and wave volume and things like that. But I think what we'll do, Jeff and I will do a quick tour through our screens, what we call our point of view, just to explain the tool set that we're using. So every day I trade 2 to 3 specific setups based upon the range formed during the first hour of regular trading hours on ES. And I do this because I'm relatively time limited. I like to constrain my trading to certain times of the day. And what I look to do is, so let's scroll this thing back so I actually get that. I will look at the first 30-minute period on ES, and I basically look to make a bet as to which side of this range is going to break. I do the same thing at the end of the first hour, the initial balance, and I'm looking to take advantage of the statistics behind breaks of these ranges, because these occur pretty much every day. Something else I do is after this range has broken, after the first hour, I want to see if it's one of the approximately 2 days a week where after it's broken, it goes all the way back to the other side and breaks the other side. So I'm looking for opportunities after the first hour to trade from somewhere inside the range to the edge of the range and maybe beyond. And then after the range has broken, so I call that inside out, after the range has broken, potentially go from the outside back in. There's only two types of trade. We're either inside a range and we're going to the edge of the range, or we're at the edge of the range and we're going back to the middle of the range. Yeah, so inside out, outside in. I'm most comfortable trading from inside to the edge. I like having somewhere to aim for, but I am not averse when conditions present themselves to going from the edge of the range back in. But lots of people go, you know, professionals always trade the edges, always be fading the higher the day, the lower the day, fade the value areas. And these people get run over. And what they don't realize as well is that when a range has formed, when I'm trying to trade from somewhere in the middle to the edge of the session, which we call a ledge, yes, an L shape, it's a ledge, then actually the professional Lee who is trading the edge is looking at the edge of whatever rotation has occurred inside. So these are a couple of the setups which I teach within our beginners course. The tool set we use are 30-minute footprint, just the raw numbers. You can ignore the orange blotches and orange lines and dotted lines. These are just some tools which I use to draw my eye to things which I know are important. They're not telling me what to do, but there are particular patterns which I'm having the computer highlight for me in order that I can make a decision. I'm not saying if there's an orange box at the top, go short. If there's an orange box at the bottom, go long. Yeah. What I educate is what are the various patterns? Anything highlighted in orange or a horizontal line is something significant. So I'm using the computer to draw my attention to things which I know are significant in order that I can then make decisions. So this is my main view of ES during the day. I supplement that with a view of ES through the whole session, which I have to the left here. I have got daily charts of all four equities here, just so I can have a rough understanding of shape. I use market profile, but I have it here as a reference point, something I'll glance at. I'm not making all my decisions based on market profile. I do have a few market profile based setups. So I've got ready access to that here. And then on my other screen, which sits directly above this screen, sorry, but I haven't talked about these. So here I've got 15-second charts with various horizontal lines on, which are just structural levels, so potential inflection points, so statistically likely areas where price will make reaction. These are very fast 15-second charts, so I can see recent history, what the price action is like, and I have wave volume, which is something we teach in terms of some of the Wyckoff setups. I use these just as if I come back from having made yet another cup of tea, I can just glance back and say, okay, over the last 3-4 minutes, here's what happened while I was gone. And it just allows me to understand that within maybe this area here, here's the movement that occurred within this area. But I'm mainly looking vertically, yeah, because price only moves up and down. Yeah, I care about the volume that has accumulated at every price during the structure of the trading session, whether it's the overnight or the regular trading hours. Now above this display, let's share the other screen. Yeah, looks like this one. I have you'd look at this and think it's a dome, yeah. What this is basically session profiles together with a trading dome. So I have got ES here. My main screen is set up so I can trade E-mini, ES. This one is set up for the micros because I might be going long mini, short micros. Yeah. I might be doing a multi-day trade using micros, but day trading or scalping the mini. So I have both instruments available to me. Here, let's just find the spotlight. Here we go. So this is ES, here's RCY, here's NQ, and here's YM, because the equities are tightly correlated and will broadly move in similar directions as a group. So we can gain extra information by looking at market correlations. So this is the closest I have to, classic dome trader view of a whole stack of domes. And I use this in order that I can take advantage of opportunities in any of the equities markets, as well as trade micros, as well as minis on ES. So I run this on two 4K screens, stacked horizontally above each other. This gives me everything I need to see in the equities as a group. And I would hope that what jumps out from this, if I go back to this view, that looks, is this right? Yeah, that looks right. We're back on my main screen, I think, Jeff, JVC. What should jump out is, do you see anything resembling classic technical analysis, wavy line, Bollinger Band, MACD, moving average crossover nonsense? Nothing. Yeah. I'm looking at volume over price divided in different points in time. That's it. So, Jeff, do you maybe want to walk through your workspace?
Yeah, let's do that. Particularly since I'm a little more of a legacy, having come from technical analysis for the first 20 years or so, or 30 actually. Shit, that's a long time. Hang on, let me grab my screen. I was in the middle of something.
Hey, Lee, by the way, real quick before you switch screens, because, well, that's okay. So, no big deal, because you can talk about it too, Jeff. But Jan pointed out that he sees a, quote, channel on your 15-second charts.
And yeah, I'm going to talk to that.
I figured you might. All right, perfect.
Yep. Okay, so real quickly, I'll answer questions about anything, but I'm just going to kind of just zoom through and give you a tour, because it will give you a real clear idea how I read the market. And it's important to understand this is one of three monitors you're seeing. And what Lee just showed you with the 30-minute structure, I have exactly that, slightly different color scheme and a little different tool set, but roughly the same thing is running on monitor to my left. And I have it running for ES and NQ over there. So anyway, having said that, I'm running some fast versions of that as well, as you see in the middle. But I'm going to, for the moment, just minimize those. And then when the market's open, this is where Jigsaw is. And I prefer to scalp on Jigsaw because, in my opinion, it is the best tool to execute against the market. You can change and move orders the fastest. So if I'm scalping, I want to be executing on the domes, but I've got it, or the depth and sales in Jigsaw. I've got this set up so that all of my accounts can be accessed in Jigsaw, and I can also trade directly off of the charts, like over here in Sierra and in Ninja. So I can basically trade in any one of about 6 accounts at the same time. And so I often do what Lee mentioned as well, where I might be scalping one way in the micros and maybe have a position on in the ES or whatever at the same time. So let me, again, just get all that minimized for a moment so we can focus on what am I looking for that I'm executing against on those Jigsaw depth and sales domes. And it's gotten to the point, because I've been doing this for so long, that I can see it happening over here. But I learned to see what's happening over here by things that occur on the different views. On the first one, we had a question about the 15-second. So let's just start there. Let me get the spotlight on, because I didn't really emphasize this yet. I've tested almost everything you could name in the markets. I've been around so long, and I'm a computer guy, so I could write lots of code. And there's really no approach to the markets that I don't have some experience with. And as far as scalping, this is the one I landed on about almost 20 years ago now. And I really like it. This is an approach using wave volume and linear regression. And I blew it up so we could look at the whole chart, but it's probably a little easier if I instead of blow it all the way up, let me just make a duplicate of this and make it larger, but not that big. So you guys can kind of see all of it at once. This is a 38-inch wide screen. So when I make something really big, it gets really small for the audience. Okay, here we go. So basically what I'm doing with those lines on this 15-second view, Jan, to answer your question, Jan or Jan, what I'm doing is I'm measuring the very short-term range. And since the market was closing, at the end of this, it's real time. So, there wasn't much happening. But when the market is in motion, when we're moving, measuring, I'm trying to just stretch it out here, which is kind of hard to do. But if you look at it down here on this one of the bottom four, the right-hand one, you can see the top of the range is 42, the bottom of the range is 40. It's the same here. It's just a little hard because the scale's bigger. That's what I'm doing. I'm looking at a statistical evaluation of the range using linear regression. I'm not using it to evaluate trend. All I'm doing is saying, if I look at a regression, and just to be clear, there we go, that's a little easier to see. A regression is math's way of saying what's the best fit. So for these particular periods, what it's telling me is the best fit is high there, low there, of all of the trading that occurred from the beginning of this kind of reddish line to right now. And it's not a trend, and it's not an average, and it's not a mean, and it's none of those things. It's a regression. And what a regression does in English is it tells you what is the best fit. So for all of this trading that went on, the best fit is the high is 42 and the low is someplace we didn't trade yet, which is like 40 and change. And you say, well, wait a minute, that doesn't make sense because it traded all the way back up there at 46. Again, how can the high be 42? Because again, it's a regression. And this is the key of everything I do, is evaluating the very short-term range, because it's very, very predictive. One example of that would be if you get to the edge of the range, so this spot right here, and the market's trading there is a 96% chance that something significant is going to happen. So one of the things that we talk about in the class in the scalping section is, how do you know that, and why is that useful? How do you trade it? That doesn't mean that it's 96% chance it's going to go back up. It doesn't mean that it's 4% that it's going to go back up or down. It means that at this spot right here, there's a 96% chance that something important is going to happen. And then we measure what importance is happening and which way it's going based on the delta, which is what I'm looking at down here. It's bar by bar delta. So we're actually seeing the trading as it's happening, and is it going through the low, or is that low getting bought? And then at the same time, I'm measuring wave volume, which is what these little totals are. And that's just the volume of the swings. And you can see I do that on some other timeframes as well. But I wanted to just answer the question about the lines. That's what they are. They are regression. I'm not going to go into the measurements or how to use them in detail. That's what the class is about. But it's a very, very precise way of measuring short-term range. And it's very, very similar contextually to using a 30-minute footprint, which many people are familiar with, to measure the A period, the B period, the C period, classic market profile. This approach here is a very similar approach. It's just using much longer time frame, 30 minutes instead of 15 seconds. And the way the data is aggregated is different. But the data we're looking at is the same. We're looking at buying and selling and what its impact is on price. And for the very short term, I'm measuring the range. Now, once I've done that, and remember, everything is a scalp until it proves otherwise, then the other thing I need to do is I need to understand the context of that motion. And this is the thing that we teach on the first day of class. If you recall the image that Lee had up here, let me just throw it up here, the class syllabus, and then I want to talk to a point on it just for a moment. Okay, so in day one, we talk about process, and this is critical because you have to have a framework to execute whatever it is you do, your plan in the market. So mine is relatively simple, and this is what it looks like. And there's some graphical versions of it that I'll share as well in the class. But basically, I look for general large-scale macro context in the market, and then I look at the price action, and that leads me to different types of trade setups. And I just showed you one example with momentum at the edge of a range. So in order to do that, you have to kind of zoom out a bit. But when I do that, I do it looking for specific things. So this is about short-term price action. This middle row is about, is the market trending, quote unquote, or not? I like to use the word direction instead of trending because I'm just going to get some more data here. Give me a second. And the reason that I do that is because a trend is looking at the past and trying to predict the future. And that doesn't make any sense to me as a guy who actually trades. I want to trade what's happening now and the future. Looking backwards is only useful in a contextual sense. And otherwise, it's not useful at all. But if you do look at it in terms of context, let's do the same thing here and make a slightly larger one of these. So I'm just cloning that one on the edge so we can get it to a more visible size. All right, that should do it. So basically what I've got right here is 3 minutes. I changed this throughout the day between 90 seconds and 3 or 4 minutes. And 90 seconds is my preferred view. Let me go on that for just a second. And at the open and overnight and anytime the market's active, that's what I'm looking at is 90 seconds. So let's just let this repopulate here and you'll get an idea. So this is Friday's session that we're looking at right now and the overnight session from Thursday night before Friday, right? And what I'm doing here is, again, I'm measuring wave volume. And here I'm doing it from a contextual point of view. For example, if the market is directional, this chunk here, it was directional. Again, I don't like to use the word trend because it's really misleading. But the different types of price action that I look at, ebb and flow, we talked about that a minute ago. Lee mentioned that. That's just when the market's doing what it usually does. It just goes back and forth in a range. And this is our favorite thing to trade because this is really predictable. And then when it leaves a range, like it did right there, a lot of people will say a trend started. Well, you know what? That's nonsense. It's not about trends. It's about your edge in the market. So when the market goes into a directional move, and that started here and that continued until it went the other way. So that right there, that entire move was a directional move. And if we look at the volume behavior within that, it's really predictive. And so that's the value of this context. So this move started, it broke out of that range with an 11,000 contract move. So in other words, from the top here until the bottom of this, it's just a zigzag, 11,000 contracts. Then it bounced on 8,000. Then it dropped on 22,000. Then it bounced on 4,000. So this is the Wyckofffian approach that I use to the market. I use it to determine if we are going in a direction that the volume is consistent with. In other words, the direction right here is down and the volume is increasing on the down moves and it's lighter on the moves up and it's making lower highs and lower lows. The definition of a trend, but again, I don't want to use trend. I want to use a directional move where the momentum is increasing into the direction we're going. This is something I want to trade either short or I want to look for high volume reversals. So that's the purpose of this middle row. It gives me context for the scalps that I'm doing on the bottom. So for example, if I'm scalping short up here in this range and that range breaks down, those are the conditions where I'll leave a runner on. Otherwise, I'll just keep playing this range and as long as it continues. So the key to this is the market's telling us what to do. The market's doing whatever it does, and we're not like waiting at, oh, I want to buy 65. We don't think that way because until we get there, we don't know what's going to happen. So at 65 in that particular example, which blue lines on my charts are the initial balance. So this was the first hour high and low for this session. And what happened was, right down here, is we established that, and Lee talked a little bit about this. And when one side breaks like this, and it doesn't break on a whole lot of energy, there's a really good chance it's going to go back this way into the range. That's a classic outside in. And up here, what Lee was talking about, inside out, happened first. So we actually got both of those. And so if I look at that context and I say, okay, if we get down here and the selling dries up and the delta switches to the buy side, I'm going to buy that, even though it's a really strong downtrend. So I'm counter trend, but I'm doing it at an asymmetric point. And that's the key to all this stuff is asymmetry. We want the odds to be overwhelmingly in favor of the thing that we're trading to happen. And if it doesn't, and it doesn't happen pretty quickly, as in the scalping, all trades are scalps until they prove otherwise, then basically we're either wrong or early, and you never sit in a trade waiting for it to work. It either works or you get out of the way and figure out why it didn't work. Sometimes it's just operator error. The beauty of an approach like this, using a process like this, is I've traded this same way for 25 years, and it's a twist on all 40 years or all 48 years. And I've taught a couple of thousand people, and most recently in TRG, a couple of hundred more, about using this approach of context, then price action, and then based on those things, looking for specific setups that give you an edge during those contextual and price action events, like ebb and flow range. I just showed you when that breaks, it becomes an opportunity, and there's setups that we can identify as a result of that. So that is kind of what my segment is about. The one other thing you're seeing on your screen is, pretty basic stuff that people see all the time. I just do volume profiles without any candles or anything, and I just look at get rid of that. I just look at where the volume was overnight in regular sessions. The blues here are the regular sessions with the initial balance high and low, and you can see, like, when it breaks the initial balance low and gets going, you get a really nice move like that. But I'm never looking at it and saying, well, there's support here at, 07 or whatever. You just let the market tell you what's happening and trade with it. So that, or if there's a reason to trade against it, as I said, at an inflection point that's really asymmetric, then that's also an edge. So that's basically what I do. I will be happy to take any questions about it. Let me, again, just so you kind of see everything in context, when I'm executing against it. Oh, and I do the same thing for gold and oil, and I'll just switch one of these views to, gold or oil. Like, for example, gold got crushed last week, and it's real easy to just flip these to a gold, and I prop up a dome for gold and do the same. But the class is going to be mostly about trading the indexes. So I just wanted to answer that question about that. Anyway, so
Jeff, before we leave your screen and you got the wave volume, you had an offline question. How would you describe your approach to trading springs and upthrusts, and what techniques do you use to trigger entries? Now, obviously we're not going to get into the meat of our training on this, because the glib answer is what techniques do you use to trigger entries? Order flow. But maybe you want to talk briefly about springs and upthrusts and Wyckoff approach on what you're seeing.
Oh, yeah. Thank you. I meant to mention that, and I got distracted because I was doing something else. Thank you for bringing that one up. Let me see. I should have. Yeah, this one right here is a good example for that. So this is just a blow up of one of these four in the middle over here on the left at 90 seconds. And that's what I'll do during the session, by the way. Either these are on another screen altogether. I bring them here all together for class so everyone can see what I'm seeing at once. But as I said, these three, or these four in the middle, I'll change from 90 seconds to 2 or 3 minutes. And what I'm doing is I'm looking for springs and upthrusts. So what I just showed when I was discussing the difference in the price action, again, this was ebb and flow in a range. And at a high volume node, you can see the volume up there on this volume profile. And then that range broke down, and it broke down on this 11,000. That's what I was talking about. That's the departure from the range. And then we did what Wyckoff calls an upthrust. We went back up, but we did it on weaker volume. So from that point forward, as long as the direction continues, what I'm doing is I'm looking for springs or upthrusts, and that's how I can determine if this is likely to continue. So for example, it got another really nice push down, double the volume of that one, and it's in these kind of low volume nodes compared to the big one at the top and the bottom. So that's predictable based on the volume profile as well. And then perfect chance to get short right here. Let me get the drawing tool. So remember I said it pushed down on this volume here, 22, and this volume here was 11. So that was double. And then it bounced on only 4. So that's by definition what Wyckoff calls an upthrust. when the market is going a direction or trending, and it has a low volume attempt to break the trend that doesn't break the trend. In other words, draw yourself a trend line here if you must, but try really hard not to do that, because that's thinking backwards. You're thinking technical analysis if you're doing that. But it works well enough to illustrate this example. And here was another up thrust right there. So these were both perfect short entries, and they proved correct immediately, and they would have been profitable trades immediately as shorts. And it's just exactly the opposite if you're looking for springs. You're looking for low volume pullbacks and for it to go up. And so that's the part of Wyckoff that I teach as a scalping methodology. And it's really simple, and it's really, really effective, and it works on any instrument. And it, it works on time frames of 90 seconds up to 5 minutes work really well. And I'm trying here. Let's see. You know what? NQ had a better example. Let's go get NQ here. So I'll show you an example of a spring really fast. We need to go back and get a few more days, though, because it didn't happen on Friday. So let's get 5. It happened the day before that. Let's pop that up, let it repopulate, give it a second. Okay. Yeah, Wyckoff, as Lee said, he was a guy that used to read the actual printed little ticker tape back at the turn of, not last century, but the one before, the early 1900s. And was a genius at determining this stuff that we can see really visually, determining that, as it was happening. It's mind-boggling to me that these guys could do stuff like this in their heads back in the day, but they could. So here's an example right here. This is NQ back a couple of days ago. And you can see, it opened and it was kind of jittery for a while. We established a nice low, and then it started, a directional move. And again, I'm not going to use the word trend because that's way too misleading, but we started going this direction, right? And so the first kind of, if you define the ebb and flow, the ebb and flow range was kind of down here. And our first bust out of it was on 33K of volume. And then we pulled back on 8K. And then we went up, not quite as aggressively and not quite as aggressively down, but almost balanced. So we established another little range right here. And then when we left that, again, we did it on higher volume. And then we got a low volume pullback and then a slightly lower one. So this would have broken the rules, but an astute trader would have been watching carefully because it was really close. And so then it came up here and it consolidated again, and then it broke out really aggressively. That right there at that point is what is called a spring. And they're really good places to look for longs. So you look for an ebb and flow here after a high volume breakout. And again, it's really easy to define a place to get out if you're wrong. But when you're right, they're wicked right. Just like when you're right going the other way, they're wicked right. So those are two good examples. Was that helpful at all, Lee, do you think? Questions in the chat? Anybody about that? I'm going to teach more about that, obviously, and how you actually do it. But that's an example of springs and upthrusts and what I do in Wyckoff in my world.
Yeah, that was good, Jeff. Thanks. So I think what we'll do, I'm going to walk through how we assemble all this into an educational package on our beginners class, and reference some of the other TRG things. And then we will open ourselves up to questions about pretty much anything.
Don't forget, we have a coupon code at the very end.
I know this well.
Yeah.
So,
okay.
To fast track people into this kind of approach and getting this knowledge, we put this class together called Order Flow for Beginners Practical Trade Setups. And it is totally focused around how do you apply these decision-making frameworks into setups. So we lead with the setups. We tell you what the setups are and what components you are looking for, and then how to execute them. So we don't go deep into the theory of why they work or what the mechanics are, because people want really quick results. But you end up with some proven setups and the basics of understanding kind of the mechanics behind what makes them what they are, and it puts you in a position, if you so wish, to dive deeper into understanding why they work. So the way in which we do this, we start on Friday, everything's at Pacific time, so 7 a.m. Pacific. We go through Jeff's process document. We do an overview of our respective setups, and we do this while the market's live. So if there's the opportunity there to actually demonstrate the setups, we trade them live. On the next day, on Saturday, we concentrate on Jeff's price action scalping approaches. So we look at price action order flow. We deal with those Wyckoff springs and upthrusts, which we've spoken about, and we look at the high momentum and high volume reversal setups. On Sunday, we dive deeply into the trade setups based on market structure and the underlying statistics. And then we look at how we can combine the statistics, market profile concepts, and reading the footprint from the raw data to do inside out trades based on the first hour's range and outside in trades based on the first hour's range. We also look at how we can trade the session edges, the ledgers. Yep. So how we can determine when they're going to break or when we fade them. We then leave a few days to allow that information to be absorbed. Now, everything is recorded. We have a huge library in Trading Research Group. We record everything. We've got thousands of hours of content now. And the homework after the weekend is review the weekend's material once or twice. Let it start to embed itself. We can say, just let it wash over you. Listen to this stuff in the background and then pay attention to it when something resonates, and rewind that section and rewatch it, because we are teaching a lot really intensively. Yep. So we give you Monday and Tuesday to do that. On Wednesday, we do another session around the live market because we review the setups. We also focus on risk management. So we do this in the context of we understand the setups. Let's start to execute some of them live and talk through how we're dealing with risk. We do another session on Thursday. This is a regular Trading Research Group live trading session. It's called a fishing trip. So you will join other Trading Research Group members while Jeff and I trade live, and we give our stream of consciousness, our narrative on what's happening in the market while we trade our accounts live. Then on Friday, we do sort of wrap up and graduation. We do quick review of everything, open Q&A from the students, and then we introduce you to the facilities and TRG and how you can make the most of your first 2 weeks. And aside from 4 or 5 live scheduled sessions every week in Trading Research Group, we have our library. If I just bring up the calendar as well. Just want you to get a sense of what our regular meeting schedule looks like. So here are the meetings for next week. This is pretty much what happens every week, as well as any other ad hoc sessions that we do. We have a full library of everything. We have got educational clinics from the past, workshops. This is stuff which you can then start to explore as a member to really build out your knowledge. Yep. We also have a online chat community, which we call the Pit, which is where we ask questions, talk about stuff, do bits of banter. It's mainly trading related and decent organization, but we'll look at platforms, hardware, trading evaluator combines, and we've got quite a lively focused community. The beauty of this, as compared to other, Facebook groups or futures.io or these kind of things, is everybody here has got fundamentally the same understanding of order flow, the same approach to reading the market. There's no noise or arguments about, oh, but you should backtest MACD, crossover, blah, blah, blah. There's very little noise because we're all on the same page. Yeah, but this is probably the largest group, an active community now of order flow traders who have got a common process and level of knowledge, I'd contend. Really focused. So this is our class. The next class starts on the 9th of July. It is $497, which includes 2 weeks membership after the class finishes of Trading Research Group. And for the rest of this weekend, so until midnight on Sunday, so when Sunday transitions into Monday, we actually have a $100 off coupon code, which is summer 2021. I'll type that in. Oh, JVC beat me to it. So we are offering all of this for the next 24 hours for $397. Why are we doing this? Because it's Father's Day tomorrow. So if you don't have kids, or if you've got really rubbish kids, use that $100 and buy yourself a toy. Buy yourself a new gaming mouse as a Father's Day gift. It's TRG's gift to you. So the URL is here. I'll copy this and put it in the chat. This is where the course exists and can be signed up with coupon code summer 2021, which is valid effectively for the next 24, 36 hours, that sort of time frame. If you go around our website, you can learn lots more stuff about Trading Research Group. You can read testimonials from previous students. So actually this bunch here up until, where are we? I think this testimonial upwards were from our last beginners class. Everything else here is from our boot camps. And then we have got various members as well who say things. Okay, you know, these are real. If you are super skeptical, we can likely connect you with people. But you know what? We're talking about a $400 training class with 6 live sessions. Yep. I'm going to say it. Your risk reward potentially is really good here. Oh dear. So,
and you know exactly where to put your stop.
Indeed, yes, it's an option. Yeah,
it's asymmetric. Exactly. Yeah.
It's a $397 call option. There we go, an asymmetric trade. If you watch this video, it's a kind of best of some of our trades. We trade our accounts, you know, every day, 2-3 times a week. We're sharing screens as we do it. And actually on this little video here, at the starting point, you see a bunch of our students and members talking about their experience. Unfortunately, we exist in an industry which is blighted by furus and snake oil salespeople. And we have to try to cut through the bad reputation that has been put out there by a whole heap of charlatans ever since, what, 1920s? And it is what it is, which is why we run these sessions where you can hear us directly, decide whether or not you like our style or approach, and how's this for a beautiful segue, ask us anything you'd like. So without any further ado, we'll open the floor to questions. No question.
Also, if anybody would like to actually just get on the microphone, we got a small group. We can easily unmute you and just let us know if you want to speak. Just say Mike or something like that in the chat, and I will gladly unmute you and you can chat.
Yeah. So I noticed we have Jan, we've got Peter as well, who joined our public Facebook group 2 to 3 weeks ago. I see some familiar names as well from the past, actually. I'm interested, and this can just be a text comment, but you know, I'm not putting you on the spot. But I'm interested if for our Facebook visitors, whether this has really fleshed out a flavour of the trading approach, the educational approach that Jeff and I take, and what this stuff is all about. Because there's only so much that one can do publicly on Facebook, and without getting into big internet arguments and this kind of stuff. Okay, so Peter met Jeff in the in the top step Facebook group, which has really deteriorated as of late in terms of quality. Mind-blowingly bad, the nonsense that's spoken there these days. But we're happy to keep this open for as long as we need to answer any questions about our trading approaches or educational approaches this class, TRG. This is your opportunity to throw arrows at us.
Yeah, the VIX NQ. That's a good one. What Lance is commenting on, somebody was, I won't name them, I don't know them, but somebody was posting this grand strategy using brackets based on the VIX for trading the NQ, and I can't. I used to laugh. It's really, I feel bad for them because these are things that have nothing to do with each other. It's the blind leading the blind. There's a lot of that goes on there. It's unfortunate. They don't moderate that group well enough.
Okay, we've got some good questions. So first one from Jan. For someone who already has some experience, is it okay to skip the course and just join the group? That I yes, it's okay, but I think for net actually $350 net because it's $400 and you get 2 weeks TRG membership. You are going to progress more slowly. I would contend. Actually, yeah, that's a great point. Lance joined us at the beginning of the year and then took one of our courses after about a month, 6 weeks. Maybe Lance, if you're prepared, maybe you'd be happy to unmute yourself and talk to your own experience of exactly that situation. If you're happy to do that, type yes. If you're not, then
we're putting him on the spot. Meanwhile, let me answer. Oh, there he is.
I had to escape screaming children in the background.
What are you doing to them?
Yeah.
Torture, of course. Yeah, no, I joined as a member, and I was kind of trying to do the same thing where I was sort of refusing to want to pay for the course, and just because there was so much material in the library, and I just felt like I could catch up and watch those videos. And there was also a glitch in the system, and I actually had access to some older boot camp stuff, and so I thought, okay, maybe if I just consume this material, I won't have to pay for that. And I did consume it really fast, and it still wasn't enough because of the context of, like, I eventually did pay for the course, and then did that whole thing, and I think that there was a lot of value in the context while they're talking about it. So I definitely recommend taking the course.
There is something educationally about hearing something live in real time rather than after the fact of the recording, and being able to pose your questions in real time as the thought hits your mind. I think this is the value of live education. Now, I've had email engagement with somebody who hasn't come to this overview session, but they have been non-stop looking for arbitrage opportunities, saying, if I join Trading Research Group, do I get access to recordings of the course? And one of our policies is after 3 months membership, or if you take a quarterly or an annual package, you get access to previous beginner course recordings. But I am pointing out to this guy, don't try and look for arbitrage opportunities to save a few $100 on education when your best experience is going to come from attending live. And it's the difference. I came up with the analogy, fortunately, to explain to an email. It's the difference between, can you teach yourself piano by watching YouTube videos, or are you going to learn better and more quickly by actually going to piano lessons with a live tutor? It's the same thing. But for whatever reason, trading is one of those things where people, Dunning-Kruger syndrome, people think they are absolutely going to be more adept than they actually are, and they can learn it themselves passively from a manual and don't need to ask questions. So I would strongly recommend that if you want to learn, do it at our pace, don't do it self-paced, and you're going to get further along the knowledge continuum than you would if you try to do it yourself. None of us are forcing you to do that, but it's our experience that it's a better way to learn. Join a live class first and do it at our pace. The other paradox we see is people finish this course and go, that's great, I've got all this, what do I learn next? It's like, what you learn next is nothing. The next thing you need to do is practice. Practice for months and months and months and get good at one thing, and then get good at another thing, get good at another thing. This is not about becoming as knowledgeable as you can be. It's about becoming as proficient as you can be. So we try to keep people on the straight and narrow on their journey to becoming proficient order flow traders too.
Well, in my observation, I don't believe it's a coincidence, is that everyone that I can think of off the top of my head, and obviously as community manager, I keep a pretty pretty close watch over what everyone's doing and where everyone's at. Everybody that I can think of off the top of my head, half a dozen people that have shown the most progress, the fastest, the best understanding, and so on and so forth, have all been people who came through one of the varied courses. They're never the people who just joined TRG on a monthly basis.
Absolutely, yeah. And it's false economy. Trying to find an arbitrage out of our tariff, or save a couple of $100 versus not learning as effectively in a business which is all about acquiring knowledge in order to make money. Yeah, it's a real false economy. You're minimizing your ROI by doing that, and you might even get negative ROI. So, okay, the message has landed with Jan. No, let me go through this again. And ninthly, I would okay, good. I saw Joel, whose name rings a bell, possibly from the world of emoji trading, I think. Okay, I see it's been answered in the chat, but we'll do this for the benefit of anyone that sees the recording. Joel asked, the charts that we're using don't require any proprietary software, just standard order flow and footprint charts will be fine. Absolutely, we are totally focused on how you read this stuff from raw data. No proprietary third-party tools or indicators. We do make use of some things to make our life easier, but all of the stuff that we're teaching involves standard platform capabilities on pretty much any order flow capable platform. We do have our individual preferences as to which platforms we like, but we're not mandating that you go out and you buy the hokey cokey 3-2-1 order flow institutional algo spotter, because that's just nonsense. Yeah, we teach you stuff from first principles and from raw data. I'm going down the list of. So GB is saying, was anyone here views Volumetrica, which is that Italian thing, or ATAS? They're all the same. Yeah. For the principles that we're teaching, if you're using this Italian thing, Volumetrica, or ATAS, or Sierra Chart, or Ninja, or Investor RT, or CQG's Legacy of Market Delta, or Quant Tower, or Ninja Trader, that exists, doesn't it? Yeah. What else is out there? Must have missed one.
Trade-of-8.
Yeah,
Your
Trade-of-8.
favorite.
Jigsaw, of course, with charting. These are all more or less capable of doing enough for what we're going to teach you. There are some deeper things which some platforms do better than others, but we are. Okay, eProx, that's Motive Wave. It's white labeled. So they are all more or less capable of showing the same basic raw data in the ways that enable you to understand it in the ways that we teach. Some do it better than others, but it's the starting point. And actually, what we teach is going to allow you to evaluate different platforms in a much better way as well. Jan is asking, what if you have a job? This is during weekdays and work hours. Well, the meat of this is at the weekends, Jan. Yeah. So the real educational piece, yeah. So the lectures, if you will, we schedule on Saturday and Sunday. The live trading sessions obviously have to occur during live market hours, regular trading hours, but everything is recorded. Yeah. Everything's recorded and put in our library within 24 hours of it going out. I mentioned emoji. I'm assuming you're agnostic with regards to their suite as well. Yeah, totally. Yeah. We don't rely on any third-party tools in our teaching. So we don't say when this tool or indicator does X, do Y. Yeah, we teach everything from the raw data. So as the creator of and owner of emoji, yeah, I maintain really strict Chinese walls, or ethical walls, between tools and education. Yeah, I teach you stuff and I explain stuff in a way that if you so wished, you could go write your own emoji. Don't do it. It's a waste of time. Yeah, it exists. Yeah. But I believe in transparency of knowledge. Yeah. Once you understand the stuff that tool sets like emoji do, then you understand the value of what those tools are and how to apply them to save time. I use emoji tools to save my time in spotting patterns. So on this chart, for example, the orange blocks are being created by Emoji Price Rejector, but I teach how to spot the pattern. Yeah, The orange blocks are there to make me more productive and free up my brain for other things. These dotted lines are being created by emoji small prints because I've told it to go and look for a 0 print within the footprint, and I want to project it until it retrades. Now, what I will teach you is why I'm looking for this. So the difference is most vendors would say, here's my magic aggression tool that shows when the market speeds up. And they wouldn't tell you what to do with it. They'll just say, here's a line, here's a zone. And are you going to trade towards it or trade away from it or trade it when it first appears? We can do all of those, yeah. Well, I just go, this is magic, institutional grade algorithm. I will teach you that we are looking for a 0 print. I will tell you why this is important and what it means. Yeah, you don't need this visualization. You can draw, if I'm saying that it's useful to bookmark this over time, you can draw it once you're able to spot it. But I'm lazy, yeah? I want a piece of software to do that job for me because I can then use the time and the brain power I'm saving on that task to do other things, like decide what I'm going to do based upon the information I'm seeing. So everything that we teach is based upon first principles, getting stuff from the raw data, understanding what it means, and then explaining how to act on it. You can then start to qualify third-party tools and add-ons to see if they make you more productive in this analysis. This is totally upside down compared to the bulk of the indicator marketeers who are out there in the world. And yeah, as has been mentioned, I do it myself. When people come to me saying, "Oh, what emoji indicator should I use to make $100 a day on NQ?" My answer is consistently none. Yeah, if you want to make $100 a day on the NQ, you have to start with being able to read order flow from the raw data and have a process and have a playbook of relevant setups. And then you can start to decide whether you invest in tools that make your life easier doing this job.
And first, you have to learn how to lose $500 a day trading NQ.
How do I make $100 a day? By losing $2,000 a day for 10 years. Yeah. And actually, most people that ask that question that way don't want to get knowledge. They want to get rich quick, which is something you can't do in trading, where you can't do it consistently. So, some good questions. How are we doing? We've been going for about 90 minutes. We can, keep talking. We can talk away forever, can't we, Jeff? But
Oh yeah.
If there are any more pressing questions, feel free. And to Peter's point about platforms, so eProcs from FT71, both Quant Tower and also Motive Wave are being white labeled quite heavily at the moment. Quant Tower started off as Optimus Flow. So Quant Tower is a Ukrainian software company who've written yet another charting platform, because the world doesn't have enough charting platforms. We always need more. So their first route to market for futures was through Matt Zimberg at Optimus. He must have had some exclusivity deal with them for a period. Then it seemed to be available for all markets, not only crypto, direct from Quant Tower. AMP now have it as a free tool. From their side, a couple of other brokers do. FT71 is offering a white labeled version of Motive Wave. Edge Pro is the same thing. So, for whatever reason, various introducing brokers, which is a terrible business to be in, race to the bottom, are, well, I partly understand that if you are being overwhelmed with support issues, because many traders are not very technically adept on their platforms or computing environments, which I really don't get. If you don't have really good understanding of your trading platform and the computing environment it's running on, which I'm not saying that's easy, but it's certainly an easier skill set than flipping trading. I don't know why somebody who is IT low capability thinks they can make a fortune in the markets using really complex software on computer hardware. That I don't get, but the world is full of them. So if you're a broker who's inundated with questions like this on why doesn't my CQG connect to whatever, then to make your life easier, you're going to offer your own platform, because you can specialize your support resources rather than trying to be an expert in every platform. but it's positioned, of course, by these brokers, never transparently. It's never, we will give you free Motive Wave. It's always dressed up as it's our proprietary platform. This industry is full of snake oil. Ugh. So that's Edge Pro or Edge Prox. Yeah, it's Motive Wave and Quantara being white labeled a lot. I have Motive Wave. I liked its dome when it was the first dome offering market by order information. Through a lot of lobbying, I managed to persuade Sierra Chart to present the information similarly on CME and now Eurex, which they do uniquely. So I'm not using my Motive Wave dome so much. But yeah, it's a good platform. The team behind Motive Wave are decent people. Yeah, extremely stable. Sierra Chart's very stable. So do we have anything else that we can answer? Or Jeff, is there anything you want to add in, or JBC?
I don't think so. I was just thinking about that as I was pondering the seriousness of the stability of Sierra Chart. That was an interesting way to put it, Lance. As particularly as a coder, it's serious about its stability. Like gracefully closing sockets. I love some of the messages. Yeah. Anyway, no, I just wanted to emphasize that this approach of process, price action, and market structure has been really successful for us as educators. I don't mean successful as we're making money teaching it, but the people we're teaching it to are able to implement it, and that's the thing we really learned from doing the boot camps and this new format where it's even faster than a boot camp. It's it's a week, whereas the boot camp was 4, and the first time I did it, it was 3 months. So we're crushing it down to the minimum bite-sized chunks you need to understand this. And so I think that's a really important point, particularly if you're coming from some sort of technical analysis background, because price action is a really, really simple way of removing all of that from your world and still getting the right answers at your edges and at your inflection points. So anyway, let's see. I saw one other comment come by. Oh, thank you, Jerry. Appreciate that. Do appreciate that. I didn't see you in the list there. It's good to have you drop in on us. Okay, so anyway, that's all I wanted to add, Lee.
Yeah, Joel was asking about data feed. Look, in part, it depends on the platform you're using. Certainly, Rhythmic with MBO into a Rhythmic capable platform is good. I think if you use Sierra, it is daft to use any other feed than their Denali feed, and the way that Sierra are going with their own direct connections to CME and Eurex, it gets them into CQG type company. They've got full vertical integration from the exchange right through to your platform. Or right through to your desktop, which is great. But if you're not using Sierra Chart, I'd say, yeah, Rhythmic, and if your platform can show the MBO, then fantastic.
I'm of the school that I've got all of them. I like to have lots of accounts and lots of different data feeds, and like on any given day, I showed you what my screen looks like. I'm running 3 main platforms, and so I'm at least seeing CQG and Rhythmic and Denali coming, and I have that running partially on Sierra. And I think it's just really good to be redundant and have lots of ways to trade. If you're at all in the NinjaTrader ecosystem, Phillips, one of their brokers they introduced to that, and Dorn, Phillips had a big problem a couple of months ago where they were just like trading people's accounts and saying people did trades they didn't, and you had to kind of work through Ninja to deal with that, and Ninja didn't do a very good job dealing with it. And so anyway, the reason I'm just bringing all that up is it's helpful to be able to go another place. But I get when you're new, you just want to get one up and running. But the reason I'm explaining all this is, again, this goes back to the idea that one of the critical mistakes newer people to this business make, and this is a business, this isn't a hobby, it's your business. Even if you do other stuff, you got to approach it that way. And the mistake they make is they think that it's one platform or it's one data feed and it's understanding the space is really what you're after. And then you should be able to execute your edge anywhere, and I think that's true. If I take my process and go on Sierra, it might take me a week or 2 or a month to get it working the way I want, but I can do it there. I can also do it on Ninja. Some things don't work as well. The footprints don't work as well. equivolume views that I like better. I like the wave volume views better. So I do that there. And Jigsaw
Oh, we've lost.
Yeah, I just muted myself accidentally. Jigsaw is just a really good execution tool. And one of the things that I've been doing lately is running all of my accounts through Jigsaw after the last Phillips adventure so that I can link to NinjaTrader and Phillips, but I can also trade direct to Iron Beam or any one of another half a dozen places I've got accounts. And particularly when the market has been weird or one broker has a problem or this data feed has a problem. There was a couple of months ago, CQG had a few days where they were, they were shutting everybody down. And so it's helpful if you're going to do this for a living to think that way. So that's just the point I'm making.
Yeah, this is the point. For people starting out, you can absolutely, become capable on one thing. Once you're at the point where you've got capability and knowledge, you actually, as Jeff has explained, you need redundancy. So, I have Denali. I have accounts that route orders through CQG. I have Rhythmic accounts, because the last thing you want is for your, my best of breed, whatever, suddenly isn't working, and you can't do anything. So there are certainly things that are better than others, but I think you want to be capable in a lot of stuff once you're at the point where this becomes your business, your profession.
Hey, I have a question for you, Lee. It's everyone else will be interested probably too. I know Sierra, has done a lot of new stuff with the Denali feed, and they're heading toward direct and the MBO data and all that. I'm still running my main Sierra through AMP, which is CQG. Is Denali in the brokerage business yet? That's obvious where they're heading, but can you open an account just with them?
No. And Sierra don't ever want to be in the brokerage business. So
with Denali, so that you just have to choose that as a feed.
And the order routing occurs right now. So at AMP, the order routing occurs through CQG.
Right. You just reroute it.
Yeah. Where once CME, once Sierra Chart productize their direct connection to the CME, which are in the testing phase of at the moment, they're already working with a couple of FCMs on Sierra/Denali actually being the order routing as well. And then the FCMs and their introducing brokers will offer that.
Gotcha. Okay. Yeah, I hadn't kept up with where that was out or where that was at. You sent me an email from their support group about 2 months ago, and I know it was still coming. So, all right, so that makes sense. So when you say Denali feed, you're still executing somewhere as well.
Yeah. So yeah, okay. on my AMP account, I'm not paying for any data from AMP using CQG or whatever. All of my data fees are being paid to Sierra for Denali, but my transaction fees, the order routing fees, are going into AMP and being forwarded onto CQG because it's CQG handling the order routing.
Got it. Okay. I see a comment in the, there's a couple comments I wanted to comment on. I love the being able to trade different strategies in different accounts. That's one of the main reasons I do it, Lance. And also being able to have opposing positions, which at one broker and one account, they'd close each other out. But in two different accounts, two different brokers, I can be on both sides of the trade. And I often do that. Lee and I talk about this a lot on the fishing trips where there might be a structural short and I'm in that, in the ES, but I'm scalping long in the micros, so that really good point, Lance. Peter made a couple of comments. I like having one data feed as well, and I run NinjaTrader I had running it with Rhythmic and using NinjaTrader Bridge to Jigsaw. That was one of my Jigsaw setups. Phillips through Ninja has discontinued Rhythmic. Now you can only get Rhythmic through Dornan. And I have Rhythmic through 3 other places now. So the only thing I'm running through the NinjaTrader bridges now is CQG. I prefer to run Jigsaw direct. I will tell you this, I've tested this, and it's not a significant lag, but if you're using the bridge to Jigsaw with any of the platforms it bridges to, there is a little bit of a beat there. It's slightly faster in getting execution fills and whatnot, which can save you some headaches if you connect Jigsaw directly to the feed, and you can do both with Jigsaw. So anyway, these are things we talk about in TRG. So I just wanted to answer that comment. Yeah, Tradeovate, again, same thing. Tradeovate is already kind of in the cloud and a bit crippled. I wouldn't use it as a professional trading platform. It's okay to learn on, but when the market is really fast and trading at limits and whatnot, that's when Tradeovate has troubles, and that's the last time in the world you want to have trouble.
Yeah. And as you Tradeovate to Jigsaw, what we basically say is Tradeovate is my broker and I'm using CQG data. Yeah,
right.
That's Tradeovate into any third-party platform.
Right, and what you can do is you can set up that same CQG connection and run it directly into Jigsaw and skip the Tradeovate part. That's what I would do if that's where your account is. Anyway, so let's see. Any other questions or comments we missed? That's not plugging straight into Tradeovate, Peter. That's called bridging. And Jigsaw bridges to Tradeovate and it bridges to NinjaTrader, but it's sharing the data feed through that. And again, this is something I know a lot about. I'm very, very familiar with Jigsaw. I do some beta testing for Peter. I know him well. There's some slight performance reasons to connect it directly to the data feed with DayTrader, but I'm familiar with what you're saying. It's just what I'm saying is, as a general manager of my trading business, in the anything but the short term, that's a bad decision because it's the least stable way to do things. And when the market is stable, everything's fine. But when the market gets fast and gets hit with shocks and flash crashes and lock limits and whatnot, the last thing you want to do is have another step in the equation. So that's what I'm commenting on. Okay, so anyway, it's important to know it's important that you can do it both ways. That's the point, Peter. Is in Jigsaw you can set up. If you look at your Tradeovate, you have a CQG data feed. That's what you have. So you can log directly into that. You could do the same thing with any. I have AMP. I can log into Sierra Chart is my AMP data feed that they all go together, with Denali, and I can put the same CQG credentials into Jigsaw and just open it directly in Jigsaw without running any of the other stuff if I want to. And from a performance point of view and execution point of view, that's the fastest way to do it. So anyway, all right. What other questions, comments? I think we beat that one. Do I have several computers for performance reasons? No, I have a simple setup. One very decent computer, but it's not by all means state of the art at the moment. It's an i7. What is this current one that I'm on? I just bought it, so I don't remember the exact specs here. I'll tell you. Let's see. This guy is an i7 10700F, and it has a 1600 Super GTX in it with 32 gigs of RAM and fast SSD. It's about optimizing the platforms. That's where the performance hangups come with trading software. And then what I do for redundancy is I just have this machine cloned with another machine. So if one crashes, I run the other one. And I only test on the backup machine. This machine, I make sure I don't put anything on here that can compromise performance. So for example, in NinjaTrader, you really have to limit the data and remove all the third-party DLLs and garbage, and you have to really trim it down to make it run well. Sierra, in its natural form, runs very well, but you have to really understand it, and the learning curve is severe. So, every one of these things you can argue pros and cons, and that's our point. That's the point Lee and I are making, that, you should only do that when you have to, and you should be agnostic. Don't marry your platform, because look at what happened with Market Delta back in 2012 or whatever. Literally went out of business overnight, and everybody that was using that was out of luck overnight. So you just don't want to be that reliant on any one. If you're going to treat this like a business, you need to have backup plans and contingencies and more than one level of them. Yeah, I've tested Bookmap. I don't find it seems to be long on visuals and short on features. I can do what it does in Jigsaw, and I don't use the visuals on the order book all that much anyway, so.
I think, Bookmap, is a visually very sexy product, which means that it can be marketed on the internet really well. that doesn't mean it is a great tool.
Right, exactly. Yes, Jan, to answer your question, I never have platform freezes or issues at all. If I do, it's a short-term problem related to something like, Ninja will update or Sierra Chart will update their platform, and a vendor, might have to catch up. And I have very few vendor code in the only one I have in Sierra is emoji, and some of the time that's not even enabled. So, and in Ninja, I use all the lifetime stuff, and I don't use any third-party stuff there at all. So that's part of the key. And the other key in Ninja is having absolutely limits in the data. And again, I test Bookmark every couple of years. Bookmap, I just tested it late last year, and I wasn't impressed, quite frankly. But
and I know, Jan, from the posts you put in Facebook, you're exploring lots of platforms and using them in parallel as well. And I would say, aside from Jigsaw and Sierra Chart, the other platforms are really resource heavy. So, Ninja is written in .NET. Oh, come on, brain. ATAS is written in .NET. Motive Wave is Java. So you've got Java compiler, Java virtual machine going on. You start to run these programs in parallel, all consuming the same data. Yeah. So you're doubling, trebling the same data being ingested into these platforms, and the same processing is going on against the tick data. You're going to start to create resource constraints on your machine. So I would contend that, okay, Jeff runs multiple platforms for various elements that he likes in specific platforms, but he is using a fraction of the capability of each platform. So Ninja is there for one task, Sierra is there for one task, Jigsaw's there for execution. And they're all pretty low intensity visuals which are going on, plus with minimal data. If you run ATAS and Bookmap and something else, loading 3 months of data doing intensive visuals, you are going to kill a machine, whatever that machine is. Right. And these .NET charting platforms really do get quite bloated. From my side, I've got a dedicated server in Chicago in East Cermak that I run some algos on, but the charts which are running algos, visually is nothing because it's all about execution speed. I have a machine here doing similar stuff but logging. That's a pretty meaty processor. That's a Threadripper, but again, that's for multiple instances of Sierra Chart. So I allocate between 2 and 4 cores to each instance of Sierra Chart and allow that particular instance to look at maybe 2 or 3 markets, 2 or 3 charts, because I'm actually logging lots of stuff on a 16-core machine. So it's about understanding your resources and optimizing your balance of platforms versus processor capability versus whatever else. As with all these things, less is more. You do not need 3 months of data on a 15-second chart.
Right. Exactly.
I have it. People do it that way.
Yeah, and you got to go in and tune all those things. And a comment also with I was on Ninja 7 and very happy with it, but I wasn't doing any footprint analysis at the time. I was running Jigsaw through the plugin that way for a couple of years. And when I switched to NinjaTrader 8, I was stunned at how bad the footprints were, and all the third-party footprints are marginal at best. And the problem is in Ninja, it's not in those vendors. And that's what got me to Sierra Chart. And so that's why I have the breakdown that I do. And it's proven to be a really good redundancy too, because, I can go through, as I mentioned, if one crashes or one broker is not behaving. And it's always good, in this industry, Lee mentioned that earlier. There's so many charlatans. The brokers constantly are misbehaving and causing problems, or the data feeds aren't running one day, when you really need it running. So, I think this is all really good stuff. And the thing that really concerns me, though, is when I see people posting stuff like Peter posted, that they're running a 12-core Xeon to run Bookmap. I would submit to you that you're over-analyzing. And I come from the school of analysis. I learned doing it that way, particularly in technical analysis. And I see people doing that in order flow. And one of the things that Lee and I worked really hard to do with this curriculum is strip it down. Like people work so hard to understand where icebergs are, and yet there's virtually no edge in understanding where icebergs are. And so that's just one simple example, where Bookmap makes a big case out of visuals of stuff like that. And yet, the edge is not in knowing where those things are. It's seeing the results of how those things trade, and you don't need a special tool to do that. So, and that's just one example. There's countless ones.
Oh, there was this guy the other day who was wondering if he could spot algorithmic activity on the tape. I'm only messing with you, Jan.
Yeah, one of the mistakes I used to make, and if you're relatively new, like less than 20 years, listen to this point. I used to think that the key to succeeding in the market was to have the most clever tools and analysis. And I would submit to you after all these years that the exact opposite is true. The key to success in the markets is understanding your edge and having the absolute simplest tools to show you where your edge exists and where it doesn't. It's akin to the old pit traders saying, I used to just listen to the volume of the locals, and when it got really loud, I would scale in, and when it got really quiet, I'd scale out and go to lunch. It's that simple. Well, order flow makes it that simple too. You can hear the volume of the market, and who's doing what. If you just get all the shit, pardon my French, off your screen and watch what's really happening. So that's really what we focus on.
I was having this exact conversation yesterday with a private coaching client of mine who runs a little boutique hedge fund for high net worth individuals. They've got about 40 mil under management. And we were discussing algo and HFT and AI. And he said, there is very little order flow analysis done by these heavily mathematical and academic funds, because it's staffed by really smart university graduates and mathematicians, not by pit traders or ex-pit traders. And the ex-pit traders suffered when things went electronic, and some of them ended up in prop firms and whatever. At the same time, computing power ramped up, and if you are XYZ company and you can throw millions at software development, you're going to hire the brightest people, brightest academic people, physicists and mathematicians. You're not going to hire Tony Maloney, who's been standing in the CME pit for 25 years, because he can't have the same conversation with the technical guys. That's really rare. And these hugely complex, AI neural networks with 10 gazillion neural nodes in them that are doing optimal curve fitting in real time on 10,000 inputs are really kind of overcomplicating it. Whereas the whole point behind analyzing order flow and trading and reading the tape is, can we see if prices are too high or too low? Now, there's more volume of data, there's high velocity of data, there are tricks that are played in the data, but it comes back to something very simple. Are we too high or too low? And if not, are we likely to go higher or lower? That's it, yeah? And then, shall we do something about it? And so it's all about adding simplicity.
Exactly. I grabbed the screen while you were talking. Yeah. I figured this was a good way to wrap up. And just to quote one of the people that I had a lot of respect for his brains ability. I was involved with a software developer. I was one of the co-founders of a company back in the early 80s that was on the team that launched software with the Mac in 1983. We had we were a third party with an app, and that was very successful on the Apple II. And so we got invited to launch with the Mac. And so I got to work kind of peripherally with him. And this really stuck with me, this kind of viewpoint that, the way you really solve complex problems is with simplicity. And I think that's a really good way to look at what Lee and I do.
And Jan has hit the nail on the head with his comment where he's saying, I guess with enough experience, you can go back to simple. Yeah, you have to understand a lot of stuff to decide what things you're going to throw away and what you're going to concentrate on. And what Jeff and I believe we have done is be able to distill down our combined, 60, 70 years of trading experience with a decent focus on order flow to come back to you and say, here's what's important. And we call it Trading Research Group for a reason. It's because new ideas come. People ask really smart questions and you learn more stuff. Jeff and I learn more stuff. This is our reason behind having the group. It makes us better and it gets us thinking about new and interesting things. But the value of the group in our education is you can really learn the stuff that has proven itself to be important. I know of one educator, they offer a 12 or 14 week course on the flipping footprint chart. Yeah, I will teach you what is important in footprint in a pretty intense 90-minute session. Yeah, but you don't need more. We had a session within TRG during this week on how I use market profile. I have slogged through the Jim Dalton books, which I find really painful to read, but I can distill it down into 2 or 3 things that really work well for me. And we covered this again in 60 to 90 minutes. So we avoid you having to kiss too many frogs. There's the tagline for TRG. Minimize the frogs you need to kiss.
Minimal frog kissing.
Yeah.
I threw up another graphic while you were saying that about, I think this is a good way to think about it. You get lots of data points of knowledge, and then experience, you kind of learn how to connect the dots. And then, creativity is really, forming edges out of that. And that's what we're about. Kiss fewer frogs. All righty. So, and that's on my LinkedIn page if you're interested, which you're probably not. So anyway, should we wrap it up?
Yeah, I think so. We very much appreciate you guys turning up and some, very insightful and intelligent questions. Just to reiterate, you will find a link to the training class and the place where you can book it on the TRG website. And until close of play tomorrow, if you wish to save $100, you can use coupon code SUMMER2021. And we hope you avail yourself of this, and we can help you on your journey in a few weeks' time.
And just one more time, I just threw that link in the chat. Thank you for the comments, the kind comments. We do appreciate it. And thank you for everybody that participated by commenting. That always makes it more fun and more interesting. Because, when you're teaching on Zoom, you can't see the audience. We're sharing charts and whatnot. So, and I have tons of classroom teaching experience. I was, and still am, a college professor, and I was a trainer for Microsoft, and I was in sales training at IBM, and have done it a lot in the venture capital space as well. So we do appreciate that, is the point. Thank you for coming, and thank you for interacting with us. And thank you, JVC, for cat herding. And
no problem. And I've got one small thought to add as well is probably everybody who saw this is in either your surfing group in Facebook or the Order Flow group in Facebook. Either one of those. If you think of something tomorrow that you wish you had asked, or tonight or whatever, message one of us, message me. I'm in both of those places, whatever. But post something on Facebook, and we'll gladly get a conversation started or answer whatever you need.
Yep, that's a good point. I just threw that link up as well for that one. Perfect. That's the TRG group one, and then my trading one is called Surfing the Markets, which is a little bit broader, but there's some overlaps. Yeah, it's fun.
Our Facebook group, I think, is approaching 4,000 members. It's doubled in size since the beginning of the year, and I'm certain at least 3,800 of them are robots in various African countries
in Nigeria.
Sell forex scams. Yeah.
It's the algos. The algos are trying to find out what
the algos are trading our group, right? Exactly.
Yeah. But for the 200 real people who are focused and talk sense, it's great.
Yep.
All righty.
So thank you, everybody. Good to see some familiar names. I see some familiar names. I've worked out who GB is. So hello again, Glavis. Nice to see you here. And also Joel. So, thanks for attending. We hope this was useful and enjoyable. We hope to see you at some point in the future, maybe for some education.